Yesterday, on May 25th, the S&P 500 closed at an all-time high of $7,549.60, with traders rallying on reports that U.S.-Iran peace talks in Doha are nearing a breakthrough. At the same time, Brent crude has been whipsawing between $93 and $114 a barrel, dropping on every hint of a deal and spiking on every defensive U.S. strike. However, this entire market reaction rests on an assumption that the underlying physical and legal reality flatly contradicts. Because even if President Trump and Tehran sign a memorandum tomorrow, the 1,500 to 2,000 ships currently stranded across the Persian Gulf are not going to move, and the 138 vessels a day that used to transit the Strait of Hormuz are not coming back. The reason has almost nothing to do with politics and almost everything to do with a small committee of underwriters in London. So, in this video, we'll explain why the maritime insurance market has effectively blacklisted the Persian Gulf, why a U.S. government backstop has so far failed to fix it, and what this means for oil prices, inventories, and the equity market over the next 2 quarters. Let's start with what actually happened on February 28, 2026. That morning, joint U.S.-Israeli strikes hit Iran, and Tehran responded by closing the Strait of Hormuz to what it called unfriendly nations. For context, the Strait of Hormuz normally carries roughly 20% of the world's oil and LNG, and pre-war traffic ran at about 138 vessels per day. Within 48 hours of the strikes, the Lloyd's Joint War Committee, the body that effectively decides where commercial shipping can safely insure itself, redesignated the entire Arabian Gulf as a high-risk conflict zone. Major insurers issued formal notices of cancellation for the Persian Gulf and the Gulf of Oman, and tanker traffic collapsed by more than 80% before Iran's navy had imposed any physical blockade. By early May, according to industry tracking, daily transits had fallen to around 5 vessels. That is a 96% collapse, achieved almost entirely by the withdrawal of insurance coverage. Now, onto the actual numbers. Pre-war war risk premiums in the region ran at roughly 0.05 to 0.25% of hull value. Today, quoted premiums sit between 3 and 8%, with U.S. Nexus vessels reportedly seeing quotes as high as 14%. In practical terms, that means insuring a single $250 million tanker for one transit has gone from around $625,000 to over $7.5 million. JP Morgan estimates that roughly 329 vessels in the Gulf require about $352 billion of coverage that private markets have effectively stopped providing. Now Washington has tried to fix this. On March 3rd, Trump ordered the U.S. International Development Finance Corporation to stand up a reinsurance facility, variously reported at between $20 and $40 billion, to backstop carriers willing to transit the strait. As of mid-May, that facility has had 0 takers. The reason, according to industry analysts, is that the program was built on a false premise. The problem was never a shortage of insurance capacity. The problem is that ship captains and owners are rationally refusing to enter an active war zone where the strait is heavily mined, where Iran's new Persian Gulf Strait Authority is demanding tolls of up to $2 million per transit, and where paying those tolls would itself constitute a sanctions violation under U.S. law. As Henrietta Trey's of AGF Investments has put it, even if a deal is signed, the world is heading for what she calls a Hormuz hangover. Richard Mead of Lloyd's List estimates that even with an immediate reopening, traffic could not normalize before September, and historical precedent from the 1980s tanker war suggests full premium normalization typically takes 2 to 3 years. So that's the supply side. The demand side is where this becomes a problem for the equity market. According to the IEA, the world has now lost over 1 billion barrels of cumulative supply since February 28th. Goldman Sachs reported May inventory draws of 8.7 million barrels per day, the highest rate ever recorded. Global stocks are down to roughly 101 days of demand, the lowest in nearly 8 years, and IEA emergency strategic releases are expected to be exhausted by July 9th. Capital Economics warns the market could hit a point of no return as early as June. And yet, the Shiller-Cape ratio on the S&P 500 currently sits at around 41.6. In 155 years of recorded data, the index has only traded above 40 once before, in December 1999, the month before the dot-com bubble began to unwind. The Federal Reserve's own May 2026 Financial Stability Report explicitly names geopolitical tension and elevated oil prices as the most pressing risks to the U.S. financial system. Ultimately, the disconnect here is fairly straightforward. The market is pricing equities as if a political agreement in Doha resets the physical and actuarial reality of global shipping overnight. But Lloyd's underwriters do not respond to press conferences. They respond to risk data, and the data currently says that the Gulf is uninsurable. As such, even a best-case diplomatic outcome leaves the world facing structurally elevated energy costs, accelerating inventory draws into Q3, and an earnings backdrop that looks nothing like the one the current S&P multiple assumes. Whether that gap closes through a faster-than-expected ceasefire and demined Strait, or through a violent repricing of equities, remains to be seen.